Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and here is a look at the stories for the day.
इस बार मनाली चलते हैं।
नहीं गोवा।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI is the banker to every Indian.
The Russian invasion of Ukraine and subsequent sanctions slapped by the West on Moscow have played out in different ways for Indian trade. While our import and export to the two warring nations have been hit adversely, there are some sectors which stand to gain from it. Like the export demand for wheat and corn has shot up. Our next report delves into all these aspects and also looks into the problems that the importers and exporters are facing.
Trade with Russia and Ukraine is a small portion of India's overall cross-border trade. However, specific commodities traded between the countries are important. Mahindra & Mahindra Group Chief Economist Sachidanand Shukla told a Financial Daily that tea exports from India and sunflower oil imports could get affected. He explained that 84% of India's sunflower oil imports came from Ukraine, while 13% of India's tea exports went to Russia. And as the Financial Daily pointed out, supply disruption in sunflower oil could become a pressure point on India's retail inflation. India is also a big importer of phosphatic fertilizers from Russia. While on the other hand, Indian exporters to Russia and to the Commonwealth independent states are reportedly facing uncertainty over goods worth $500 million. This is because of three broad reasons. First, the withdrawal of credit guarantee protection on commodities. Second, the restrictions on Russian banks. And third, the disruptions at Baltic ports amid the Ukraine war. The Federation of Indian Export Organizations has said that export cargoes to Commonwealth of Independent States countries have been impacted because no shipping line is willing to take consignments there. This is because there is no movement of ships through the Black Sea. Indian exporters fear that payments worth about $400 million might get stuck. This is because Western nations have blocked many Russian banks from accessing the Society for Worldwide Interbank Financial Telecommunication or SWIFT platform. Exporters have found that many buyers do not have the ability to make payments in any foreign currency or from a third party or country, but they have shown willingness to make payments in ruble. Against this backdrop, multiple sources told Business Standard that the government might soon allow bilateral trade between Russia and India in their national currencies. Such a step would be taken to avoid any trade disruptions. The rupee-ruble trade arrangement will bypass the sanctions imposed on Russia by the West.
We have a lot of business with Russia in components, machinery. We import a lot of components for earlier machinery and other equipment supplied by Russia. So Ukraine is a big center for sophisticated component manufacturing. A lot of our goods go through Caspian Sea to Odessa and other ports, which ultimately finds way into Central Asian countries or Russia or other part. The immediate thing is payment system. There are already goods on high seas. There are already goods in a port like Antwerp and other port on transitment to various parts of Ukraine. Second thing is the Western countries have stopped SWIFT system. So what will happen to the payment which are on the way to banks? So we have to find, government has to sit down and find some ruble-rupee payment system. You see, we have got this when we were dealing with Iran. Apart from that, ECGC cover. All our exports are covered by credit guarantee schemes internationally. And in turn, our credit guarantee schemes and other, they also get their insurance covered with international insurance companies. What will happen to that? we seek some financial assistance from the government to extend export credit guarantee, not only guarantee, but also export finances for a further period. See, there are some long-term contracts. So we'll be manufacturing, supplying, and what about the money stuck up there and the bank interest? Because bank will start penal interest.
Citing sources, another news organization reported that the sanctions would have a negative impact on India's trade with Russia when it comes to commodities such as automobile components, pharmaceuticals, engineering goods, agricultural products, and telecom equipment. In particular, Union Finance Minister Nirmala Sitharaman is concerned about exports of Indian farm produce to Ukraine and Russia being disrupted. However, there is a silver lining too. According to a recent report by One Financial Daily, export demand for Indian wheat, corn, and spices has seen a significant rise after Russia invaded Ukraine. International trade would be shifting sourcing to India since supplies from the two countries have come to a halt. Russia holds sway in the world metal supply. According to Chrysler Research, Russia and Europe together account for nearly 10% of global primary aluminium supply. As far as the steel trade is concerned, it is the second largest exporter with a 13% share. As worsening tensions threaten supply, exporting countries including India may step in to plug any gap. Russia exports around 30 to 33 million tons of steel. Meanwhile, a news agency reported that India is considering guarantees of lenders' letters of credit and soft loans for exporters hit by a cash squeeze. The government is also mulling asking state-owned banks to lend to exporters at reduced rates or provide funds to them directly up to the amount of pending payments from Russia and Ukraine.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Back home, a different sort of uncertainty is going on, and that is about the future of work. While another wave of pandemic ebbing, organizations are again perplexed. According to the latest findings by PwC, about half of India Inc. leaders feel unsure about the future of work. Let us know more in the next report.
With signs of normalcy appearing after 3 waves of the pandemic, companies across the world are outlining their return to office plans. Over the last 2 years, organizations moved from physical to virtual to hybrid way of work, where employees are being given a range of flexibility. As we move ahead, reimagining the workplace and work model comes with its own set of challenges for HR leaders. In this context, a PwC report based on its Future of Work and Skills survey has provided insights into the impediments that often prevent organizations from becoming future ready. It has revealed that 50% of India leaders agree there is a need to plan for multiple possible futures around the workplace and workforce. However, cost pressures and the fear of setting a precedent is holding them back from taking action. 48% of Indian leaders agree it is important to identify the potential risks associated with replacing human work with technology, but are reluctant to create a culture of transparency, and concerns about potential consequences act as barriers. And about 54% of leaders realize the importance of identifying the skills needed to keep pace with the changing times. However, they are reluctant to take action due to competing priorities. The PwC report also revealed that the future of work involves tapping into talent virtually in Tier 2 and Tier 3 cities on the one hand, and leveraging the gig economy on the other, with offices evolving into a workspace of the people from workspace for the people in the past, aligning individual purpose to organizational purpose has now become all the more critical in driving growth in a hybrid world. PwC's Chaitali Mukherjee said that workforce challenges seem to be more employee-driven now. Therefore, it is important for companies to prioritize leadership capabilities in order to orchestrate changes. HR leaders collectively identified 6 no-regrets moves as important to their workforce strategy. These are: anticipate and plan for the future, build trust in the organization, optimize workforce productivity and performance, enable the skills of the future, prepare for and deploy technology with humans in mind, build ability to rapidly access and deploy talent. The survey also confirmed that remote or hybrid work boosted productivity in most workplaces. Given these findings, now is the time for leaders to build an environment that supports sustainable productivity rather than fret about monitoring employees. Giving workers flexibility to manage their work and home lives as they see fit and take time to rest, and supporting their diverse circumstances and needs will help them to be healthy, mentally and physically, and this will make them perform well in the long term.
क्या हाल?
मत पूछ यार,
फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The ongoing conflict between Russia and Ukraine has cast a spell on equity markets. Friday should be no different as Indian markets track their global peers. Business Standard's Puneet Wadhwa spoke with Mark Mobius, founder Mobius Capital Partners, to know his views on the latest developments and when the stock market will start its upward march. Mobius had some interesting thoughts on how investors should position themselves in the current scenario. Let's listen in.
Hello, Mark, and welcome.
Hi.
So what's your interpretation of the recent geopolitical situation and its impact on the global financial markets? Is the worst behind us, or are we in for more pain ahead?
No, I think what we're probably going to be looking at is a long, drawn-out situation, war in Ukraine. It doesn't look like Putin will give up easily. And of course, the Ukrainians are not going to give up easily. And more importantly, the Europeans and the international community generally are in support of the Ukrainians, and they're going to try their best to support the Ukrainians, which makes things much more difficult for the Russians, of course. So I think we're looking at a drawn-out situation, which makes Europe somewhat dangerous and makes other countries around the world much more attractive.
So if the European markets shiver, which all markets across the globe do you think will catch hold?
Well, I think the other markets outside of Europe will do well because they will be safe havens. So the US equity market, the Brazilian market, South Africa, China, Taiwan, all these countries that are not involved in this European situation will do quite well, I think.
What about the US and Indian markets?
Indian market, of course, will do well because they are somewhat isolated from that situation as well. And the US market should do well as well. The only hiccup and the problem facing markets around the world, of course, is the fear of higher interest rates. But this is a very temporary fear because as we look at history, you'll see that interest rates don't really have that much impact on the stock markets. They have a big impact on the fixed income market, of course, but not the equity markets.
Indian markets, Mark, they are grappling with the problems of their own. On one hand, they are looking at the US Fed hiking rates. We are looking at higher crude oil prices that can stoke inflation fears. Then we have the impending state election outcome sometime next week. So all this doesn't it make Indian markets a little more wobbly over the next few weeks or few months?
Well, yeah, in the short term, you'll get some wobbliness, you might say. But in the long term, the Indian market should do very well because you've got very productive companies, very profitable companies. You've got a government that is intent on modernizing the economy. So all of the technology that's being brought to bear is going to have an incredible positive impact on India going forward.
What's your view on how central banks will respond to the recent developments? Do you see them printing more money, going easy on the rate hikes over the next few months?
I think central banks realized they made a big mistake in lowering rates to such a low level, and now they're trying to catch up. In the U.S., as you know, the inflation numbers show 7.5%, and of course, interest rates are way below that. So they're going to try and catch up. Of course, the complications of the Ukraine war may cause them to slow down their rate hikes, but generally speaking, they're now in a catch-up mode, and you're going to see rates going higher.
What are your views on the Indian markets per se, Mark? What kind of returns can one expect over the next 1 year or so?
Well, this year is going to be a mixed picture. You're probably not going to see the incredible returns that we saw last year, but I think they'll be reasonably good, maybe 5-6% like that. But it's anyone's guess, depending on what the macro situation develops globally. But I think, you're going to get returns, but not as good as last year.
So rising oil prices are another worry for the Indian markets, which, they can have an impact on inflation. How do you see corporate earnings play out in this backdrop over the next few quarters?
You must remember, we're coming from a year last year where the earnings picture was very bright. Now it's mixed, and some companies are coming off this euphoria. So you're probably going to see the more moderate numbers. But again, it depends on the company. Some companies are going to do very well, and of course others will not. So it's individual company.
So at the aggregate level, can you put a number to it?
Well, the economy is going to be growing at 6-7%. So you can expect a range of between 5 and 10% for most of the companies.
What has been your strategy over the past few months? Have you been looking to increase exposure in India or in any other markets?
No, we have not been moving in any direction, either selling or buying. If prices come off, we do have cash reserves that we can use to buy more stocks, particularly in India.
So which stocks and sectors in the Indian context would you look to invest in?
Well, as you know, we're big on technology. We like software companies, but we also like medical field, medical testing. And some of the industrial companies are doing quite well. India needs a lot of infrastructure, home building taking place. So companies in that space are doing well as well.
Foreign investors, Mark, have been selling Indian equities since October 2021. Do you see this trend reversing anytime soon? And what is the key indicator that they'll be looking for over the next few months to start pumping money here again?
I think the key indicator will be actions in the currency markets. We have to look at the Indian rupee to see where it's behaving against the US dollar and other currencies. If the current rate continues at these levels without any big change, then we can be pretty much assured that we're back to normal and we're going to see good earnings numbers coming in.
Primary markets have seen a lot of activity in the past 1 year. And probably they're now gearing up for their Aramco moment, so to say, in the initial public offer of the Life Insurance Corporation. Do you think that there's enough appetite amongst investors, foreign and retail, that can absorb this kind of a paper at this time?
Well, most of the large investors around the world are index investors. They're not buying individual stocks, they're buying indexes, and they're buying ETFs. So once the life insurance company enters the index, these people will be forced to buy the company, because in order to be in line with the index, they must buy this large cap stock that's entering the index. So in that sense, yes, the large institution will be buying.
So at a time when the foreigners were selling, retail investors proved to be a backbone and held the markets at reasonably good levels. So what's your advice to them right now? Should they go all in, or will the markets give them better opportunities to invest over the next few months?
I think in this environment, it's a good idea to have maybe 10-15% in cash, waiting for the opportunities, because we may see more downside. Nobody knows whether the market's going to jump up or go down. And if you see a market coming down to more attractive levels, then you can use that cash to go in.
Thanks a lot, Mark, for your time today. We hope to see you soon.
Thank you.
अब क्या किया? शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the markets, let us move on to the automobile industry. About 16 years ago, the government had slashed the excise duty on cars measuring less than 4 meters in length to decongest the roads. Since then, there is no looking back for compact cars. Our next report tells more about cars of this segment and the taxes they attract.
The Union Budget 2006-2007 was a turning point for the Indian auto industry as the government brought a lower excise duty rate for cars measuring less than 4 meters in length. The excise duty was reduced from 24% to 16% for such small cars with petrol engines not exceeding 1200 cc and diesel engines not exceeding 1500 cc. As a result, car makers flooded the market with smaller cars that were built keeping Indian rules in mind. Many of India's top-selling cars today are from the sub-4-metre category, such as Maruti Suzuki's Wagon-R, Swift and Alto, Tata Nexon and Hyundai Venue, among others. The excise duty was further slashed from 16% to 12% and then again to 8% in 2009. Large cars attracted excise of 20% instead of 24%. Before the new indirect tax regime came into force in the form of GST, small cars attracted an excise duty of 12.5% and VAT of 14% that varied from state to state. This effectively added to around 28%, whereas larger cars were taxed 39 to 45%. This meant that car makers were incentivized to make small cars. Some companies added booths to their hatchbacks and introduced them as new sub-4-metre models, while some shaved the length of their sedans to stay within this limit. Over the years, sub-4-metre compact SUVs also gained in popularity. After the implementation of the Goods and Services Tax in July 2017, cars attracted a GST rate of 28% in India and a cess that ranges from 3 to 22%, taking the effective tax rate to up to 50%. Including the cess, sub-4-metre cars with petrol engine displacement less than 1200 cc and diesel engine displacement less than 1500 cc are effectively taxed at 29 to 31%.
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का वीडियो KYC सेविंग्स अकाउंट।
Finally I agree.
SBI is the banker to every Indian.
By 2026, India is forecast to be among the top 3 automotive markets in the world. That's all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.